The effect of liquidity on investment behavior. We are seeing a very peculiar market where we have over 15,000 crore of money under SIP. Out of this 15,000 crore, close to 1/3 of that sum is only going into small cap funds. I just saw a table of the assets under management of top small cap funds. I find that they have doubled in a very short span of time. Some of these funds have close to 40,000 crore of assets. Ironically, the same fund house doesn't have large cap funds with matching size. Just imagine if you have to deploy so much liquidity in an illiquid market, where would you go? This is where I think the promoters are playing it very intelligently. Today, companies in the small cap space are raising capital using this liquidity. So, you're going to see a lot of QIPs, private placements happening. You're also going to see promoter shares being placed with mutual funds. All this seems to indicate that liquidity is driving behavior. Because of this liquidity, the fund managers are forced to buy, forced to look at new opportunities, forced to look at larger parcels of shares in the small cap space. If not for this SIP amount and if not for the flows in lump sum into this space, the fund managers would probably think very differently about investing at these levels of the market. But they don't have a choice now. We are giving them money and they are forced to look out for opportunity. So what would they find? They would try and find the best available opportunities. Naturally, these choices will be marked by tremendous compromises. It's inevitable. Anybody who has to deploy money will have to compromise on what he is buying. The compromise could be on valuation or even on the investment merits itself. If it is valuation, then we could say that maybe there could be a time correction of 1 or 2 years, after which the investment would start paying off. And whenever growth accelerates, probably even the price that they pay now may become justified. But where they are making compromises on the investment merits, then we are setting ourselves up for future trouble. We will see these investments come to pinch us and haunt us. The last time we saw money being raised by small cap companies in this way, we did not get good results. In fact, all of us think that post 2018, it was the change in taxation and the governmental intervention which caused a crash in small cap. I think it was also due to a lot of companies raising money, after which their performance didn't hold up. So the promise which they displayed before raising capital was not sustainable after they raised the capital. And naturally, large investors lost confidence in them. This time too, we have set ourselves up for this risk, and promoters selling their shares to mutual funds is definitely a very dangerous sign. I noticed one company which is a very decent company in the capital goods space where the promoter has sold a significant parcel of his shareholding. He's gone below 50%. But what really surprised me or worried me was that he was actually willing to spend even more. He was willing to dilute himself further. What does this say? It says that the promoters themselves think that these valuations are not sustainable and they are willing to give supply to the institutions. Many promoters think that if they sell now to institutions, they could buy these shares back later when the valuations soften. So they are trying to make a trade in their own shares. All these things are definitely warning bells. But investors don't seem to be bothered. They are partying on very happily. They are giving money in lump sum and SIP to the mutual funds. We are seeing the category of funds which participate in small cap raising the most money, and no one is telling don't give us money. So no one is turning the money back, happily taking the money and deploying it to the best extent possible. So it's more of investing on a best effort basis that seems to be going on in the small cap space. Liquidity driving behavior always doesn't end too well. Thank you for watching this video.